In this lesson, let's look at the key components of CAPM, market price of risk, and security market line. Suppose a market portfolio has n stocks, including GE, and we have the covariance matrix and the weight for each stock. We can calculate the portfolio variance with this formula from Chapter 7 when we discussed the Markowitz model. We can also calculate any individual stock's contribution to the portfolio variance. For example, for GE, it's GE's weight times the sum product of the weights of all stocks and their covariance with GE. The sum product inside the bracket can be simplified to covariance between market portfolio and GE. GE's contribution to the market portfolio variance is GE weight times covariance between the market portfolio and GE. The reward to risk ratio for the investment in GE is GE's contribution to portfolio risk premium divided by GE's contribution to portfolio variance. The weight is cancelled out. What is left is GE risk premium divided by covariance between GE and the market portfolio. Similarly, the reward to risk ratio for the market portfolio is market risk premium divided by market variance. It's known as the market price of risk. This is similar to the Sharpe ratio, except here the denominator is variance rather than standard deviation. The market price of risk represents the incremental return demanded by investors for holding portfolio risk. In equilibrium, all investments should offer the same reward to risk ratio. In the first lesson, we mentioned one of the key words in CAPM is risk in equilibrium. When risks are in equilibrium, all securities have identical reward to risk ratio. In equilibrium, GE and market portfolio have the same reward to risk ratio. Rearranging the terms in the equation, we can get GE risk premium is equal to market risk premium times covariance between market portfolio and GE divided by market portfolio variance. The ratio of covariance between GE and market to market variance is called beta. It measures GE's contribution to market variance. We just derived the CAPM equation, the relationship between the expected return and beta. The expected return is the sum of risk-free rate and beta times expected market risk premium. This relationship holds for any individual asset and any portfolio of assets. For a portfolio of assets, portfolio beta is the weighted betas. The market portfolio includes all securities, so it has a beta of 1. Security market line is the graphical representation of the expected return beta relationship under CAPM. It measures risk premium as a function of beta. X-axis is beta, y-axis is expected return. In a way, it's similar to CAL or SML, measuring the expected return, but CAL is a function of standard deviation. The x-axis is sigma. In market equilibrium, all assets fall on the SML because they are fairly priced. Underpriced assets lie above the SML and have positive alpha. When an asset is underpriced, the asset has a low price, which means a smaller denominator in the expected return calculation. That's why the expected return lying above what the SML suggests. On the other hand, overpriced assets fall below the SML and have negative alpha. The market portfolio is on the SML. It has beta equal to 1. The risk-free rate is the y-intercept. When we draw a linear line connecting y-intercept and the market portfolio, we have SML. The slope of SML is the market risk premium. CAPM seems straightforward, but we have difficulties in testing CAPM relationship. In reality, we cannot observe CAPM market portfolio, but we can use an observed but perhaps inefficient stock index portfolio to test the CAPM relationship. To test CAPM equation, expected risk premium equal to beta times expected market risk premium, we can run a regression of excess returns of stock I over a period. According to CAPM, lambda 0, the average alpha in the sample should be 0. Lambda I, slope of the SML, should be market risk premium. Lambda 2, the risk premium due to firm-specific risk, should be 0. Eta should be 0 mean residual of the regression. The beta and sigma squared used in the regression are estimated from a time series. The estimations of these two parameters have large errors because beta might be correlated with residual of each stock and errors in these estimates. Also, the error terms in the regression may be correlated across stocks. The measurement errors cause downward bias in lambda 1 and upward bias in lambda 0. Even if returns are simulated using CAPM, the regression test still shows that CAPM is invalid. Another issue is that alpha, beta, and residual variance are changing over time, but regression does not account for it and is likely to lead to forced rejection of CAPM. From the investment industry standpoint, an index portfolio is considered efficient as the market portfolio for all practical purposes. Research shows mutual funds on average do not outperform the market index, such as S&P 500. This suggests CAPM seems to be optimal.